Jamie Dimon of JP Morgan, he's been saying, this crisis has been sort of avoided and ignored, the debt crisis, here's government debt. But this time it's probably not going to be washed away, that it's going to have consequences. How about this? If the economy goes into a tailspin because of the busting bubble, like 2000, 2008, initially everybody ignored it for a couple of years. We have a mortgage crisis. It was getting worse. Fed said, no problem. Finally, it busted. That's when the average guy got impacted by a collapsing stock market. He didn't own stocks. He lost his job. His wife lost her job, whatever. All of a sudden, their income dropped. Panic set in, emotion. This time it's likely to be far worse. Jamie Dimon of JP Morgan, he's been saying, this crisis has been sort of avoided and ignored, the debt crisis, here's government debt. But this time it's probably not going to be washed away, that it's going to have consequences. In other words, real world consequences, not just chatter about, oh my, the debt ratio is wrong. When that happens, the central bank is the chief firefighter. Has to be. I mean, it comes in to save the government debt, which saves the government. It has to. So central government policy and central bank policy here and elsewhere, no doubt, will have to shift to more monetary excess once again, even more than they've done regularly. There's always monetary excess, growth in the money supply, artificially low price of money, interest rates. But when this kind of accident lands in their lap, that's when they have to do something fairly dramatic because it's a huge time bomb. It's not a little one. And that creates further monetary distortion. What drives gold? The ongoing decay in the money units, the real value. And that will be a facilitator to more or less fuel inject the gold uptrend to more vertical manner. So that's why we tell our subscribers, don't just look at gold, look at the stock market, look at the bond market. Look at the dollar, which is now, and by our metrics, we turn bearish at 104. It's trading at 98 right now. US dollar index. That's one piece of fiat versus others. It's not real value. It's just relative. All those things are indicating further fuel for gold because the governments will have to panic. Now, Powell has played this game of poker saying, oh, everything looks pretty good on the economic side. Well, today they just got a number that didn't look so good. And really inside the job market numbers, they don't look good because it's mostly government growth. Last job report was like 50% of the growth was state and local government, essential to the commodity, to the economy, right? Anyway, those data points will go fast to the south and he'll have to change his mind. And already he has two, and there are probably 3 or 4 ready to come on board who want to cut rates now. And he's resisting them as well. Well, suddenly he's going to have to decide, does he want to go down in history as somebody who was fighting the president and even members of the Fed and was lagged to reality? Or is he going to finally get in tune and anticipate, which they're supposed to do, upcoming changes? And I think when they shift, especially when the stock market starts to break and create discomfort, emotion, the bond market remains at high yields, doesn't even have to go higher. But if it did go lower, I think it could be a mini panic. There's certain levels on T-bonds, you mentioned TLT, that if we drop below, and it's several points below TLT, that's all, it could precipitate a puke, a sharp, rapid, instead of an erosional weakness, a sharp panic. Now, undoubtedly the government will take military-type steps to defend against that. So I don't know that the panic would last, but it would cause the government to be provoked, not incrementally, but, all of a sudden in this new direction, central bank. And that is what will fuel inject gold. And I think all these things combined are essentially merely further fuel for the monetary metals waiting when they occur to cause acceleration in what's already going on.
We've lately seen a renewal of concerns about the JGBs and the fact that they might be also a threat to the unwinding of already pre-existing unwinding of the yen carry trade. I've had a great conversation about this with Francis Hunt a couple of weeks ago. What is your take on that? Is this the Achilles heel?
We've not looked at the JGB. I know it's in a similar crisis mode. And I know the Japanese certainly have earned it. Okay. They invented QEs. Okay. And so, finally it's coming home to bite. You can try to distort reality and delay it. And they've delayed it, a couple decades now, several decades. But ultimately it creates error, distortions, and now it's come home to their bonds. So, we haven't looked at the timing of that situation or the technicals. We're looking at U.S. bonds. But I can see it's going on over there too. You can't have Japan and the U.S. have a government bond crisis. You can't do that. You might as well have World War III. Okay, I'm far more concerned about that than World War III, and I'm sure the central governments are as well. So I don't know what measures they're going to concoct, but we know some of the tools they've used in the past. In fact, the Boston head of the Boston Fed about 3 months ago, this woman made a speech. It was about a week after Powell gave us another one of his reassuring talks. Everything's great. About a week later, she gave a press conference or a talk, and I forget which, but one of the great lines from her talk was, the Fed is ready to use miscellaneous tools to defend against any financial crisis. Why would she make a statement like that when Powell is reassuring us everything is comfy? And she made a statement, we're ready to use multiple tools. Well, that means not merely interest rates, but QE and who knows what else they've got. Okay, she said that. I can't believe she made a speech or a press conference like that without getting some kind of prior approval. Maybe she didn't, but it was very revealing, that sentence. And I think that's what's behind the doors at the Fed. Even though they smile, they know there's something wrong here, and it's right in their lap. So, print, guys. That's the only thing they've got. Last time around, it was energy in that late 2020 to early 2022 move where the Bloomberg doubled in a year and a half. Energy tended to be at the front end of that, oil prices, in terms of percent gain. Grains had a pretty good move, but I'm not so sure it's going to be energy leading this time. I think energy will be dramatic because we have a very clear, not a price level, but a momentum structural breakout that will occur if you close any month during this quarter at $70. Next quarter, it'll adjust down a bit. We're a few dollars below there right now, like pushing at it. You slip out and close over that average, which happens to be the 3-quarter moving average of oil. There's a structure there, meaning when you plot an oscillator momentum chart of crude oil, you would see a trend line that you can't believe the precision of it. When you look at a price chart, you cannot see that structure. In other words, getting over 70 doesn't mean much when you look at a price chart. From momentum, it smacks you in the face. It says, I'm coming out of here. That will probably be very coincident with Bloomberg getting up over 106.50 on a monthly close anytime this year. Annual momentum of Bloomberg is positive, but in the recent pullback, it slipped back below its 3-year average, which in and of itself wasn't structurally important. It's just you cross below the average. Sometimes that's not important. It's the structure on the oscillator. But over the last 2 years, there have been multiple rallies by the Bloomberg, each like 4 or 5 rallies, that each time they get up to 106.50 to 108 in price, there's a ceiling. And they can't close a month over the 3-year moving average. It's a structure. In other words, if you looked at it, you'd see a structure you can't see so well on price. You close over that number, it's saying, I'm up out of the base. I'm breaking out of my base. I'm reasserting the ongoing trend, which commenced in October 2020. This is the next wave. And I think this time the Bloomberg will be in sync but lagged to gold. Like I said, commodities don't always move with gold. There are a couple periods in time they have. Stagflation in the late 70s. Stock market was a wasteland. Commodities exploded. On the tail end of gold, which was already exploding. Then again in 2006, 7, and 8, commodities exploded along with gold. And so forth. So I think they're about to get back in sync so that when you look at the horizon of categories, and say, where was the best place to put my money? Well, there's a slightly awakening investor crowd in the US that's finally realizing maybe gold. I think Europeans and Asians have long known this. But the Americans, for some reason, are lagged to that. They're very underinvested in gold and gold related. Gold has been the ongoing place to be, but suddenly you'll look at commodities and say, what's going on here?